I'm excited to share with you why multifamily is a stronger, more reliable investment than any other investment that I've been around. So multifamily gets its strength from the way it's valued. It's valued based off of the NOI and the cap rate. Number two, it gets its strength from being able to afford dedicated property management. Property management that is just going to focus on this property, not on additional properties, but this property. Number three is it has immediate cash flow. We don't have to wait to do construction to generate cash flow. It has cash flow from day one. And then it has reduced vacancy risk. Number four is economies of scale. Because multifamily is 100 units versus 1 unit, you get better value when you're talking to vendors. You get better value when you're talking to suppliers. You get better pricing. And what does better pricing mean? That means a lower expense, which means a higher NOI, which means more value for you and I.
So talking about valuation here for a couple of minutes, I wanted to kind of highlight how single family is valued, right? So here in this example, we've got two very similar houses, two very similar single family houses. They're in the same general area. They're both 3 bedrooms, 3 bathrooms, and they're both about the same square footage. But a vast price difference, right? And that comes down to your comps. It comes down to your amenities, what fancy things one house has that the other doesn't have, your neighborhoods, and even the marketing that was put into both of these houses, right? Maybe someone's got a much better agent, takes better pictures, makes the house look much better. Single family valuation comes down to these things and comes down to the comps. When I'm putting an investment together, right, do I want to rely on comps and people's perceptions and emotions to value my deal? No, I don't want to leave that kind of thing up to chance, right? So that's why I want to look at multifamily. So multifamily is valued. Really, the valuation on multifamily comes down to just 2 numbers, guys, right? Your net operating income and your cap rate, capitalization rate. The NOI is your bottom line profitability on the company after all expenses are paid, right? And the cap rate is really, you can think of it as the rate of return that's expected to be generated by the property. And this will vary from market to market. If you look over on this slide here, guys, you can see the formula right here. Property value equals your NOI divided by your cap rate. So just to dive into, what is your NOI? What is your cap rate? To help visualize it, right, let's look at a P&L here, a profit and loss statement. Your profit and loss will start off with your income, your rent from your property, your other income, your pet fees, your laundry fees, all that kind of stuff. And then you'll be taking away all your expenses for the property, all the things that are costing you money, your landscaping, your maintenance, your admin fees, your property management. All of these things are taking profit away from you. Your net operating income is your bottom line on your P&L, right? This is after all your expenses are taken out. This is the controllable number. As you take control of these properties, you're going to make improvements. You're going to make them better. You're going to raise the rents, right? You're going to get this NOI up, and that's going to drive value for you. The NOI is something you want to take a look at, really closely when you're evaluating these properties. You should be scrutinizing all your expenses, all your income line items, looking for risks and opportunities. This is a very powerful number in your property analysis.
Yeah, I totally agree with you, Brian. So one of the opportunities that I often look for when I'm reviewing my my profit and loss statement would be like a capital expense, an expense that happens one time at a property, like a roof, right? So what a lot of owners will do is they'll apply that capital expense as a repairs and maintenance, but it's not a typical repair and maintenance cost or expense. It's something that happens one time and it's good for 10, 15, 20 years. So if you remove that expense from the profit and loss, all of a sudden you get a little pop in your net operating income. So that's what the game is here, is to increase our net operating income. So if I can find where property owners are putting capital expenses into their profit and loss statement, then I can find value. I can find ways to increase my net operating income right at ownership. So that's why it's a super powerful tool to be able to dig into these numbers and understand these numbers so you can find the value. It's like searching for buried treasure.
All right. And how about the capitalization rate, right? The cap rate. Cap rates are different for different markets. And really the way I think about the cap rate is it's your implied risk or security of that area. You know, when you've got a booming market with good job growth, good population, income growth, you know, sooner or later, investors are going to take notice. They're going to want to go and buy some properties in that area. That's going to drive up the demand for properties in that area. And as demand increases, your prices are going to increase. And when that happens, the cap rates are going to go down. So you could say that the perceived risk in those booming markets is much lower and the prices investors are willing to pay is much higher. The flip side of that scenario is declining markets, markets where employers are moving out, people are moving out, right? You're going to see a lowering in property demand and a reduction in investment. You know, these property prices are going to decline and cap rates are going to go up. The perceived risk of these markets is much higher.
Yeah, I totally agree. So just to hammer that in a little bit, so the way so as cap rates go up, as cap rates increase, your value is going to decrease. So if your cap rate was 10%, right, and it goes down to 6%, then the value is going to go up. Whereas if the cap rate is 6% and it goes up to 10%, the value is going to go down. Your property is going to be worth less. Like when your cap rate was at 6%, say you were able to get like $10 million for your property. Well, if your cap rate goes up, now you're not going to be able to get $10 million for your property anymore, right? So the value and the cap rate are inversely correlated. They're inversely related to each other.
So let's do some quick examples here. Property one, let's say, generates $1.2 million at a market cap rate of 8%. So what does this calculation look like? Well, you take $1.2 million and you divide by 0.08 for 8%. And you get $15 million. So that's the value of this property. Well, let's do another one. All right. Property number two generates annual net operating income of $600,000 at a cap rate of 4%. So how do we solve for this one? 600,000 divided by 0.04. And that result is the same $15 million. Now, how's that possible, right? Well, my cap rate is half of what property one's is. So you can see the huge power that you have in a cap rate. These properties property one had double the net operating income, but at a cap rate double, the value is actually the same. So you can see cap rate makes a huge difference.
Totally agree. Right? Totally agree. This is where real wealth is created here, right? Because you see this 600,000, right? That's like what Brian was saying. It's half of what the net operating income of property number one. Property number two at 600,000, right? But because its cap rate was 4%, it created a value of $15 million, right? So if the cap rate was for this property, for property number two, was 8%, that would mean that would be $7.5 million. So So you created by investing in a cap rate, an area with a cap rate of 4%. You created $7.5 million. That's where true freedom comes in. That's where massive value is created, right?
So what have these cap rates been doing over time? Well, you can see that there is on a national level, right? The cap rate compression can occur. And that means when net operating incomes stay the same, however, cap rates decrease, generating more value, more higher prices on these properties, right? You know, in today's environment, we've got record federal stimulus. Over $14 trillion has been dumped into the economy or will be dumped into the economy as a result of trying to fight off this coronavirus. The Federal Reserve has kept interest rates at 0%, right? You can see what kind of impact this might have to asset prices going forward. There's a strong argument to be made that this cap rate compression will continue into the future.
Totally agree. This is where the wealthy get extremely wealthy when cap rates compress. Because you saw it here. You had a cap rate of 8% for $1.2 million. NOI created a value of $15 million. Cap rate that compressed down to 4% was able to create $15 million worth of value with an NOI of just $600,000, was half the NOI. Why was it able to create that much value? Because the cap rate compressed, right? So multifamily is extremely powerful because it also has dedicated property management. So like when you have a single family property, right? The property management typically costs you between 8 and 12% of your monthly rental value. Whereas multifamily will cost you between 3 and 10% of your monthly rental value. And for the properties that I go after, 100 plus unit properties, I'm seeing my property management right around that 3 and 4%. So let's look at property number one. It's a single family home and it generates $24,000 in annual rent, right? If we're paying 10% of that to property management, that's $2,400, $2,400. This is a high percentage of total profits lost to paying for property management. And this can only fund a portion of one person's time. So you don't even get a dedicated person. You're getting a person that's only going to be at your property when there's a call or there's an issue. It's not going to be someone that's going to be there full time showing your property 7 days a week, Monday through Friday, right? This is someone that's just going to show up when they need to be there. Whereas multifamily will have a dedicated person that has a leasing office on site. They're there Monday, Tuesday, Wednesday, Thursday, Friday. And if you have a lot of vacancy, they're going to be there on Saturdays and Sundays because there's an urgency to get the property rented out. Right. So let's look at example number two. For property number two, it's going to be a multifamily deal. It's going to generate annual rent of $3 million. 4% property management cost, that's only $120,000. That's a lower percentage of the total rent generated than there was for the single family property. You can have 2 full-time people dedicated to the property. They're dedicated to leasing the units. They're dedicated with dealing with the issues from the tenants. Like for single family properties, you can hire a property management person, but they're not going to be there at all times. Multifamily has the person there dealing with all of the issues at all times. So the property management is much more cost effective on multifamily properties. Single family owners are usually either fully involved when they don't have any property management, or they're somewhat involved when they have the part-time property management. Now, for me, this was a big pain point because I wanted to grow and I wanted to expand. But when I was dealing with the condos and the single family properties and then, you know, the duplexes, the triplexes and the quads, I didn't have enough spread between the rents that I was getting and then the mortgage and the other expenses to really afford a full property management. So I handle all that myself. But handling all that myself meant that I had to deal with the tenants to collect rent. I had to deal with the tenants when they had leaky toilet. I had to deal with the tenants when the sinks were clogged. And that there didn't allow me to scale as fast as I wanted to scale. And your tenants get better service when you have a full site team on site, like a full dedicated team on site, servicing your client. If the game is to service the tenant who's then going to pay for the mortgage, like multifamily is the way because you have someone on site being able to take care of their needs and wants. And then, you know, property owners have better control because they have people there managing the construction, right? So like imagine having 10 single family homes spread across the city and trying to manage the construction of 10 single family homes. You're never going to be at all of those places at one time. Whereas multifamily, you have 10 units that you're renovating. You have one person on site and they can go to the 10 units all throughout the property. The vacancy risk for multifamily is reduced. So that single family property, the picture on the top, right? You have one tenant there, right? If that tenant moves out, now all of a sudden you're 100% vacant. Where if you have a multifamily property and you have 100 units, right? You have 10 tenants move out, you're still 90% occupied. I mean, you're still receiving money to pay for the bills, the mortgage, the expenses at the property. Whereas single family, the person moves out and all of a sudden you're stuck paying the mortgage, you're stuck paying the rent, the expenses at the property. You know, multifamily, you don't have that problem. You have more tenants to distribute the risk out, right? And then the slack from the vacant units will be covered by the leased units. So if you have 10 vacant units, the 90 leased units is covering the slack that the 10 vacant units was causing the property.
So let's take a look at a quick example of this when we talk about unexpected vacancy, right? So on the top here, we've got a single family property and on the bottom, a multifamily property, and they both kind of run into an unexpected vacancy issue, right? So let's look at the single family property. The top portion represents what the initial plan for the property was. Okay, we're gonna rent it out for $2,000 a month. We're gonna have $1,000 a month of expenses, and then we're gonna have you know, a mortgage for $600 a month. And let's just say this property ran into some renovation delays, right? So contractors couldn't show up. They weren't able to get the property renovated until 3 months later. So what happens in this case, right? Well, for single family, you're totally vacant now. You've got no income coming in. You've still got the mortgage to pay, so you're just bleeding money out for 3 months. Then, you know, come October, you finally get the contract work done, you get the renovations complete. Now you can start charging your rent, right? But if you look at your total estimate for what you thought you were going to make, $2,400 for half a year, and what you actually made, you lost money. You went negative $600. Now let's compare that to multifamily, right? So multifamily, we thought we were going to get, okay, $50,000 a month of income, expenses $25,000, NOI $25,000, and a mortgage $15,000, right? We thought we were going to make $60,000 on this property for half a year. Renovation delays kicked in, and we'll say, okay, 10% of units, we weren't able to renovate those for 3 months, right? So we lost $5,000 worth of income. Expenses stayed the same. In reality, they might have gone down a little, but for this example, we'll say they stayed the same. And that flowed straight through to net operating income. Mortgage stayed the same. And the important thing here, guys, is that we were still cash flow positive for this property, right? Even though we ran into delays on multiple units. At the end
Right.
of the day, we made $45,000 when we thought we were going to make 60. So not as good, right? But that's only a 25% reduction. We did not go negative here.
Right. Yeah. So like, just to dig into this a little bit more. So for the single family property, right, where Brian's getting the $2,400 is the $6,000 for the NOI after the half year total, $6,000, and then you have a mortgage of $3,600, and the difference between 6,000 and 3,600 is 2,400, right? And then we have here at the bottom the renovation, dealing with renovation delays. You have a NOI at the end of the half a year of $3,000 NOI, and then the mortgage is $3,600. So that's a difference of $600, and that's why it's a negative $600, because your mortgage was $600 higher than your NOI of $3,000. And then on the multifamily property, after the half year, it generated NOI of $150,000. And then we had a mortgage of $90,000. The numbers are bigger here, but you can see, now all of a sudden you're generating, you have $60,000 in total, right? You were able to have $60,000 because you had additional tenants. You had additional people to distribute out the risk to, right? So then here at the bottom, dealing with renovation delays on 10% of the units. So that means if it's a 100-unit property, 90 units were occupied, 10% were under construction, and we were dealing with delays. We had an NOI of $135,000, mortgage of $90,000. We still generated $45,000 in income. And the difference between the $45,000 and the $60,000 is the 25%. It wasn't a negative 125%. It was just 25%. And the property was still making money. That's powerful. So then we have economies of scale. When you have economies of scale, what does that mean? So like from a vendor cost, if you're buying 100 refrigerators, if you're buying 100 stoves, if you're buying 100 microwaves, you're going to get better pricing than if you had a single family property and you were just buying one stove, one microwave, or one refrigerator, right? From a maintenance standpoint, you're going to have a maintenance technician on site. So he's going to be able to take care of a lot of the maintenance issues that come up on site. Whereas a single family property, you're going to have to hire a subcontractor just to take care of one-off issues that come up for the tenant. So your costs are going to be much higher, right? So you get economies of scale. Brian, do you have anything you want to add to this slide?
Yeah, this is just if you look at the top right here, this is kind of your classic, cost of production. As you produce more units, your average cost of production on those units should go down. And this applies to multifamily, right? I think of the quantity of production is kind of like your quantity of units, right? If you've got more units, your cost per unit should be a lot less, right? You got one roof to maintain on multiple units. You've got economies of scale everywhere with these assets.
Totally agree. So is there really even a competition between multifamily versus single family? In my mind, what I've seen, and I've been through the single family journey, multifamily gets the gold medal. What do you think, Brian?
Every time.
Great. So that's why multifamily is so much more powerful than single family.